Morning students, welcome back to this session on NDS. So today we'll continue with our discussion on the financial instruments. As we discussed in the last session, that today we are going to practice questions around financial instruments. There are a few things other than this practicing of the questions that we need to necessarily do today. So one is about the computation of EIR. Second is about hedge accounting. So we just touch upon that because hedge accounting is more of a summary, or you can say a brief, which is required to be understood. We don't need to get into too much details at this level as of now. And third, and I would say the most important, will be about any of your queries. So if you have any queries around whatever we have discussed, just make sure that we discuss today. They will also be around later on, but it's better that while we are discussing this topic, at that point of time, we are also discussing the queries, because that is how you will be able to maintain the flow in respect of this topic as well as other topics. All right. Yeah. So with this, we can just begin with our discussion on the questions. So we can pick up question number just 1 minute. Yes, so if you can go to question number 1 on page number 12.181. Yeah, so let's begin with our questions from this. As part of staff welfare measures, Y Company Limited has contracted to lend to its employees sums of money at 5% per annum. Yeah, the amounts lent are to be repaid in 5 equal installments for principal along with interest. So Y Company will give the loan to employees. As part of this arrangement, 5 installments will be considered. The market rate of interest is 10% per annum. So the company will give loan at the rate 5%. Market rate is 10% per annum. So that means rate has been considered at below market rate of interest. Y Company gave 16 lakh to its employees on 1st of January 2000 X1. So this is 1st of January 2000 X1. So this is 31st December 2000 X. Sorry, this will be 31st March 2000 X2. So this is how this will continue, and the loan amount given is, you can write 16 lakhs. Following the principles of recognition and measurement as laid down in Ind AS 109, you are required to record entries for the year ended 31st December 2000 X1. So in this case, what are they doing? They are picking up calendar year. So we will make it 31st December 2000 X1. Also compute the value of the loan initially required to be recognized and the amortized cost for all the subsequent years. Okay. So we are required to compute the amount for all the subsequent years. This will be 2000 x2 This will be 2000x3, this will be 2000x4 and 2000x5. For the purposes of calculation, following discount factors at interest rate of 10% per annum may be adopted. So now in this case, market rate of interest is given and the question is also giving you the PV factor. So at least this computation is not required to be done by you. This is already given in the question. And this will help you to a great extent because as we have discussed that whenever you pick up any PV factor, then you need to just move on to the decimal places as much as possible. At least 3 should be kept. But when the PV factor is given in the question itself, so you will not be required to think, should I consider 4 decimal places, 5 decimal places, and there will not be any variation in the answers because each and every student will pick up this PV factor. Yeah, all right. So let's compute this, and let me just first of all understand from you. Yeah, so few things that we will start with. In this case, I have few questions which you need to answer, and I would need your participation. Okay, because that's very, very important, because if you don't participate, then the entire purpose of discussing the questions will be defeated. So few questions, and I need your immediate responses. One, this accounting which is required by the question, in whose books it's required to be done? In whose books this accounting is required to be done? I mean to say, will this accounting be required to be done in the books of holder or issuer? Means holder or issuer. Correct? Yeah. So this is my first question, A. My second question. In the books of holder, how would you classify this loan as? So in fact, I can just change the question. Who will be the holder and who will be the issuer? C. In the books of holder, what will this instrument become? Means nature of instrument. Okay, and of course the classification of instrument. D. In the books of holder, what will be the classification of this instrument? E. In the books of issuer, what will be the nature of instrument and what will be the classification of instrument? Yes, this is F. This is also issuer and this is also holder. So too many questions other than this computation which is required to be done by you, because this is very, very important for all of you. Yes, quickly, can you please start answering this? See, if you answer all of these questions, that will demonstrate that you have revised the previous concepts. And this will really help you to understand all the previous concepts that we have discussed so far. Okay, yeah. And I would once again require participation from all of you, because if you participate and if your responses go wrong, it doesn't matter. Important thing is for you to attempt all of them and answer me. So all of these A, B, C, D, E, F, you need to answer first of all. Yes, quickly. We will get on to the computations also. You may be thinking, sir, why we are not getting onto the computations, why we are not solving this full? Because this is the base. This is the most important part. Yes, quickly. Okay, great. Anjali is saying, sir, Y is the holder and it is financial asset for Y. Okay, so Anjali is saying, who is the holder? Y. And because it's Y, so that's why it's financial asset. But I think you have not answered in whose books this accounting is required to be done. So there are many questions which you need to answer, but it's good that you are identified Y as the holder. What about others? Okay, Pujita is saying, sir, holder is Y. Accounting is required to be done in the books of Y. Okay. So accounting is also required to be done in the books of Y. In the books of Y, it will be a financial asset. Very good. Issuer is employee. Okay. So then, who is the issuer? Employee. And its amortized cost for issuer, financial liability, sorry, amortized cost. Then she's saying it will be classified as amortized cost. Then she's saying for issuer, it will be a financial liability. And then amortized cost once again for the issuer. Very good. Let me just understand the response of Kaustav. Kaustav is saying accounting will be done in the books of holder. Y is holder, employees are issuer. For holder, it is financial asset and amortized cost. Very good. Preeti is saying, sir, issuer means employees, holder is Y. Holder is having business to hold and SPPI. Very good. She has also explained why this classification will come. Great. Shavi is saying it's Y limited books to start with. Then Anjali is saying in the books of holder, accounting is required to be done. Great. So I think this completes and I can understand you are all moving in the same direction. Anjali is then saying, sir, it will be measured at amortized cost in the books of Y. Yeah, great. Now, if you look at all of these questions which I have asked you, all of these questions were largely answered in the question itself. But still, it's good for you to ensure that who's the holder, who's the issuer, whether it's a financial asset or not. I'm not saying that in the exam also you will be required to do that. No. Currently, we are doing this for the purposes of our practice. Okay? Yeah. But in the exam, because you know it's a financial asset, it is required to be measured at amortized cost. So that's why you need to just move on quickly. You will not test it. Fine? Okay. Now, I have one more question. So A to F are done. But other than this, I have some more questions. G. Okay, so I'm continuing with my questions. Now, as you have all mentioned that for holder, it's a financial asset, wherein it will be measured at amortized cost. Now, considering the numbers which are available and the fact pattern which is given in the question, can you tell me how will this financial asset be measured initially? And H, how will this financial asset be measured subsequently? And you can just sort of give me steps if you want. If you want a sort of detailed answer, you can give me. If you want to keep your answer in brief, that is also fine. But don't just answer saying that this will be measured at amortized cost. So amortized cost is what I know. But in terms of initial and subsequent measurement, you need to just tell me as to how I would now approach the solution. Yes, quickly. How do I need to approach this? because the next step will be to solve it. So how do I need to approach this? That is when I need to understand from all. Yes, quickly. Yeah, quickly. I need your responses quickly because you should understand that in an exam, you will not have so much time. So the same thing you should consider over here. And I think I received this answer, yes. So Anjali is saying, first of all, we need to find the present value. First of all, we need to find the present value. We need to compute the present value of the interest of loan. Okay. Present value of interest at market rate. All right. Any more thoughts in case you have, or in case you believe that this response is not complete? Anything else? Okay, great. So Chavi is saying initially we need to measure at future for fair value. So we are required to calculate the present value. Okay, great. What about others? Any more thoughts from your side? Okay, Preeti is saying initial measurement will be at present value at the rate 10%, and Kostab is also saying the same point, but Kostab has added to this. Kostab is saying present value of cash flows over the term. So this will not be really limited to interest. So Kostab is saying this will be covering all the cash flows. Yeah. Then Pujita is saying present value of both interest and principal, which means all the cash flows. And subsequently, it will be amortized using interest rate. And I think she has also worked out the numbers. Very good. Yeah, fine. So with this, theoretically, we have discussed all the points, and it's good to understand that you understand all of these points. Now we will get on to the computation. See, as we all know that if you know the principles and if you can just, set the framework as to how this complete solution is required to be given, then the computations are not difficult. Those are very, very easy. The most important point in the exam at every point of time for you will be to go through these questions, A to H, which I have discussed with you. All right? Yeah. So let's begin with the solution now. Okay. Now, as you mentioned, what's the first step? The first step for us is to compute the present value, because we understand that 16 lakhs will be collected after 5 years. So on this date, 16 lakhs will be collected. And every year, what will be collected? Interest. Interest at the rate 5% will be collected. Interest. And here also interest will be collected. Okay. Now, for all of these cash flows, means all of these inflows, because it's the holder, for all of these inflows, what do we need to do? We need to compute its present value. So let's start solving this. Okay. So we have this year end, 2000 x1, 2000 x2, 2000 x3, 2000 x4, 2000 x5. And I suggest all of you to please solve this independently. You should not follow me. You should solve this independently. That will be great if you do that. Then the principal, then the interest. Okay, so what's the amount of principal? The amount of principal is what? So the way the solution has come out, so it says 3,20,000 per annum. So if we pick up 3,20,000 per annum, what does it become? Total of this will become 16 lakh. Okay, yeah. And then we can also compute the interest on this. On 16 lakh. So in the first year, what will happen? See, the solution has assumed that every year the repayment of principal is also happening. Solution has assumed that every year there is also a repayment. Fine? Correct? So if you go back to the question, please, it says the amounts lent are to be repaid in 5 equal installments for principal along with interest. Yeah. So I think this part of the question we did not note, which the question has considered. So that's why 5 repayments of the principal are coming over here. So I think we ignore that part. So I'll just add principal over here. Principal over here. Principal over here. Principal over here. And of course, over here. And in this case, we can just take away the 16 lakhs. Okay, yeah. Now, in the first year, what will happen? We will compute interest. So, interest comes out to 80,000. How do we compute it? 16 lakhs into 5%. In the first year, 16 lakhs into 5% will be the interest amount. Okay, yeah. Then, in the second year, once again, first of all, let's plot the cash flows. In the second year, 3,20,000 will be paid. So here, what will happen? 16 lakhs minus 3,20,000. That will be paid. This is paid. So we will have 16 lakhs minus 3,20,000 into 5%. Into 5%. So what do we get? We get 64,000. So in the second year, the interest comes out to 64,000. Okay. Similarly, in the next year, what will happen? 16 minus 320 minus 320. Minus 320 minus 320. So this will become 48,000. If you have solved this, you can just start sharing the numbers with me, please. Okay. Similarly, in the next year, interest will be 32,000. Then it will be 16,000. Fine. Yeah. Then we can compute the total amount. So what's the total? 3,20,000 plus 80,000. So you can say A and B. Total is A plus B. So this will become 4 lakh. Then the next one become 384, then 368. This is 3,68,000. Yeah. Then it is 352, then 336. Okay. Yeah. And then we will compute the present value. So present value will be computed for both these two. The PV factor is available for us in the question itself. So what's the PV factor? So we can just plot down the PV factor over here. 0.909, 0.827, if I'm not wrong, yeah, 0.751. That's the PV factor. Then we have 0.683. Then we have 0.620. So we can say C and this is D. And then what we need? We will say C into D. Then we will compute the present value. Simple to do. Shalini's response on questions A to B. These are all correct. Very good, Shalini. So Chavi has also shared the numbers with me. Okay, Chavi has computed all of these numbers, which are good. Thanks, Chavi. Okay, so now we can move on to the present value. So can you also move on to the present value, please? Yeah. So the first, it's 363,600. Then we have 3,17,568. Yeah. Then we have 276,368. Then we have 2,40,416. Then we have 2,08,320. And then of course the total 14,06,272. $14,06,272. Okay, yeah. Clear? Yeah. Okay, so let's now, if you are done with this, we can move on to the accounting entries. So the question says we need to pass the accounting entries for the first year. Accounting entries are required for the first year only. We are not required to pass the accounting entry for the 5 years. Yeah. But this computation of amortized cost, that means subsequent measurement, is required to be shown for all the 5 years. Yeah. So what we can do is, first of all, we can record the accounting entries at the time of initial measurement, and then we can move on to the subsequent measurement also. Yeah. So I'll clear this part now. Okay, so the figure that we have as present value is 14,06,270. Now let's begin with the accounting entries. On 1st of January 2000 X1. So what's the first entry that we will pass? We will record the staff loan or employees loan. So we will say employee loan or staff loan. Debit. What's the amount at which it will be recorded? 14,06,270. Yeah. And what's the money which has been paid? 16 lakhs. To bank. 16 lakhs. So the money which is paid out is 16 lakhs. So what's the difference over here? You remember? What's the difference? What's the difference? The difference is 1,93,728. 1,93,728. That's the difference. And what will this difference become? This difference will become prepaid expense. Prepaid expense for the staff. So we will say prepaid staff cost debit 1,93,728. Alright, yeah. So at the time of initial recognition, this is the accounting entry that we need to pass. Okay, but are we done with the accounting entries? No. We have only looked at the accounting entry which will be passed on this date. The accounting entry which needs to be passed on this date is pending. So we will get on to that accounting entry also slightly later. First of all, we need to compute the amounts on this date. Currently, we don't know the amounts on this date. We need to compute that. Okay. Yeah, we need to compute these amounts. Can you please help me to get on to those amounts? If you have already computed those amounts, can you please help me with the numbers which you would have computed using amortized cost? So I'll clear this part because I now need to move on to the subsequent method. If you have already solved this, it will be good to understand that. Let me just see if any of you is solving that or has solved that and sharing the numbers with me. Okay, so I'll wait for your responses. Now the second part. What's the second part? Subsequent measurement. So calculation of amortized cost. This is the subsequent measurement. So once again, this will be done for all the 5 years. Now this will be done at the end of the year. So we have year end 2000 X1, 2000 X2, 2000 X3, 2000 X4, 2000 X5. Correct? Yeah. And we are now beginning with this present value. What's the present value? 14,06,272. So the opening balance that we have, 14,06,272. Now what do we need to do? We just need to simply prepare an amortization schedule, or you can say a repayment schedule, wherein we need to bring in the interest. And this interest once again will be at 10%. Why? Because we have computed this present value at market rate. So we will also compute the interest to be recognized in the books at 10%. Even though actual interest payment is at 5%, but that's the cash flow. That's not accounting. Correct? So in the first year, what will happen? We will get 1,40,627. How do we get it? 14,06,272 into 10%. Simple? Yeah. What's the repayment? Then we have repayment. Now this is already computed by us. So at the end of first year, year end. Okay, and this should not be year end, this should be mentioned as year. Year end. What's the repayment? 3,20,000 plus 80,000. So if you go to the first table that we prepared, we have repayments at end of every year. Okay. So this will be 4 lakh, 3,20,000 plus 80,000. So what's the closing balance? Closing balance will be 14,06,272 plus interest accrued less 4 lakh. So we will say this is A plus B minus C. So this will be A plus B minus C. Yeah. And can you just compute this amount and let me know the answer? Pujita has solved all of these. Very good. And Pujita has also shared the numbers. Pujita is saying, sir, it should be 4 lakh over here, and the next number is, then she has computed this for all years. Very good. So this will be 1146,899. 1146,899. Okay. Yeah. Now this closing balance will become the opening balance over here. 1146,899. Okay, and this is something which is also called as amortized cost. Now similarly, we will accrete interest on this at the rate 10%. So this will become 114690. And once again, we have this repayment of 3,20,000 plus 64,000. 3,84,000. And then we get the closing balance of 877,589. Okay, this then becomes the opening balance. Yeah. Then we recognize interest on this. 877,589 we can pick up. And then we have this repayment amount, 3,68,000. And then we get the closing balance. So what's the closing balance? 597,348. 5,97,348, which then becomes the opening balance. All right. Yeah. Then we once again compute the interest, 59,735. Then we compute the repayment, 3,52,000. And then we get the closing balance once again, 3,05,083. And then we pick up this balance as the opening balance on which we will once again compute the interest. So this comes out to 30,508. But now there could be a slight problem. This will be 3,36,000, and after which it should become 0. Now, sometimes, once again, if we compute interest on this at the rate 10%, then our closing balance may not match with what is required. And this is once again because of approximation. This is once again because of the approximation, correct, which we might have used and which should not actually come, but even if it's coming, we should correct it. How do we correct it? We pick up the balancing figure over here, like it's done in the question also. So this will be the difference between these two. So you can specify difference is due to approximation. Okay, clear on this? Yeah. If you have any questions around it, please let me know. Chavi has also computed these numbers, and Anjali has also shared the numbers with me. Very good. Yeah. So we have also given the solution for the subsequent measurement. Now the only part which remains in the question is about accounting entries at year end. Yeah. That will be very easy for us to do. Yeah. Okay. So let's go down to those accounting entries at the year end. On 31st December 2000 X1, the first entry will require accretion of interest. So what will happen? Staff loan will increase. So we will debit to finance cost. What is this finance cost? Interest expense. And what's the amount? 1,40,627. Okay. Yeah. And once again, at the year end, what do we need to do? You remember that prepaid staff cost that needs to be amortized equally over the 5 years. So we will say staff cost debit to prepaid staff cost. And how do we compute it? So we had this 1,93,000 as the staff cost divided by 5 over a period of 5 years. So this comes out 38,746. And sorry, yeah, so this will be finance income. Sorry, I marked it wrongly. This will be finance income. We can just rectify this, please. Huh? This will be finance income. Because the asset is increasing, so we are getting income over it. You can just please rectify this. Huh? So at one side we are getting an income, and the other side we are getting cost. Where do we take it? P&L. Where do we take it? P&L. Where do we take this? This will be balance sheet. And where do we take this? Balance sheet. Okay. All of you clear on this? Any questions, any doubts in case you have on this, please let me know. Yes, any questions in case you have on this? Any doubts in case you have on this? No? So we are all done. Shall we move on to the next question? Yeah, shall we move on to the next question then? Okay, so let me just move on to the next question. So we can now go to illustration number 6. On the same module. Illustration number 6, page number 12.177. Illustration is 6. So let's begin with this illustration now. ABC company issued 10,000 compulsorily convertible preference shares, and these are cumulative. So compulsorily cumulative convertible preference shares on 1st of April 2000 X1 at the rate rupees 150 each. Compulsorily cumulative convertible preference shares were issued at the rate 150 each. Yeah, 10,000 were the number of preference shares. Rate of dividend on the preference shares is 10%, payable every year. Dividend is 10% per annum. Preference shares are convertible into 5,000 equity shares of the company at the end of 5th year from the date of allotment. So we have this 1st year, 2nd year, 3rd year, 4th year, and 5th year. 5th year, conversion will take place. And they will be converted into 5,000 equity shares. That means every 2 preference shares will convert into 1 equity shares. Why? Because we have 10,000 preference shares and they will become 5,000 equity shares. So the number of equity shares is available today. When the preference shares are issued, prevailing market rate of interest for similar debt without conversion option is 15% per annum. So market rate is 15% per annum without conversion option. Okay. Transaction costs were also incurred on the date of issue of preference shares, equivalent to 2% of the value of proceeds. 2% of the value of proceeds. Yeah. So date of allotment is available, date of conversion we can just have. So that's 1st April. So this will be 31st March x2. This will be 31st March x3. This will be 31st March x4, 31st March x5, and the date of conversion will be 31st March x6, or we can say 1st of April x6, which is given in the question. Total proceeds we can compute 10,000 into 150 each. So the total proceeds are 15 lakh. Transaction cost will be what? 15 lakh into 2%, 30,000. This is again given in the question itself. And the EIR is also available. And once again, this will be your query. So how do we compute it? Yes, today we will get onto this computation also. EIR is also available, 15.86%. You are required to compute the liability and equity component, if any, and pass the journal entries for entire term of arrangement. Entire term of arrangement means for all the years you are required to pass the journal entries. That is from the date of issue of preference shares till the time they are converted as per the relevant Ind AS. Okay, yeah. Now, once again, before we get on to the computations, there are few questions which will be important, on which you can definitely help me. One, who is the issuer and who is the holder? Who is the issuer, who is the holder in this question? Yeah, so once again, you will say that, sir, every time you have the same query. Yes. Who is the issuer and who is the holder? Secondly, for the issuer, what will be the nature and what will be the measurement criteria? What will be the measurement criteria? C, in whose books this accounting is required to be done? So as per the question, in whose books accounting is required? Okay, so I have very few questions this time. C, and we can do D. This is also for the issuer. Yes, quickly, can you start answering these questions? Yes, quickly, can you please start answering these questions? All of you, can you please start answering these questions? Okay, great. Chavi is quick on to this. Chavi is saying, sir, ABC is the issuer. Okay. What about others? And what about remaining questions, please? Yes. I'm sure all of these questions will be very, very easy for you to answer. And I'm waiting for your responses. Kaustav has answered all the questions. Kaustav is saying that ABC is the issuer. For issuer, it will be a compound financial instrument wherein we will be required to separate equity and liability. Yeah. And accounting will be required in the books of ABC. That means issuer only as per the question. And that's correct. So this is all that we need to understand. And I'm sure that you will know as to why I am asking all of these questions. Because throughout, whenever we have discussed about financial instruments, some of the areas wherein we have struggled have been these areas only. Who has been the issuer, who has been the holder? That's been very, very difficult for us to assess. How will that measurement will happen? How will that measurement happen? That can be easily identified by us the moment we get onto the issuer or the holder. Yes or no? Yeah. So that's why it's very important that we understand these points carefully when we read these questions. Okay. In the exam, once again, you will have to be just very, very careful about these aspects. Even though the language of the question may appear to be very straightforward, and you may think that no, I'm answering this question confidently, so that's why my answer will be bang on. But still, it's better to just go through our concepts and think about the issuer and the holder. Because the moment you will just make this error in terms of identifying the holder and the issuer, what will happen? Entire solution will go wrong. Fine. So then in the meantime, I have received various responses, very good. So Chavi is also adding on to this. Chavi is saying, sir, it's compound financial instrument. Anjali is saying it's compound financial instrument which needs to be segregated into two parts. Great. Then Chavi is saying it should be measured initially at present value of the FC. That means I think compound financial instrument you're saying. Subsequently at amortized cost. Okay. Pujita is saying it's a compound financial instrument and ABC is the issuer. Subsequently, it needs to be accounted for as per amortized cost method. Anjali is then saying, first of all, we will measure financial liability and balance will be the equity. Yes, very, very important. In this case, all of you need to remember that even though you are saying that initially it will be measured at present value, subsequently it will be measured at amortized cost. What is it that you do first when you separate it? First of all, you will compute the value of liability and the residual value will be assigned to equity. Ambika is then saying, so in this case, principal component is compulsorily payable in equities. That's why it's a compound financial instrument. Great. So we can now get to the solution. So what's the solution for us? To break it into two parts. And how do we break it into two parts? First of all, we will compute the present value of the cash flows attached to the liability portion. Okay, so I can just take out this part. I think the facts are all known. So I can take out this part. Yeah? Or you need these? You need this? Okay. So then I'll use the remaining space. So we will put the years and then we have the cash flows. So what are the cash flows? So every year there is no principal in terms of repayment. It's only the dividend. So in the first year, dividend amount will be what? 10% of 15 lakh. Correct? So we can say 31st March X2, 31st March X3, 31st March X4, 31st March X5, 31st March X6. Yeah. So what's the cash flow? cash flow will be 15 lakh into the contractual payment, 1,50,000, which continues to remain same every year because there is no repayment of the principal. So that's why it remains same every year. It remains same every year. And then we need to get on to the PV factor. So in the question, now the PV factor is not available. So we will have to compute the PV factor. Okay, yeah. So PV factor you can all compute. I'm just using whatever is available in the solution. So in the first year, PV factor comes out to 0.869. See, I am taking 3 decimal places, but if you look at the solution in the material, you will see 6 decimal places have been used. And why they have used 6 decimal places? Because the more and more decimal places you use, the more accuracy you will get in terms of the solution. But unfortunately, we cannot get onto n number of decimal places. So that's why we can cut it to say 3, 4, 5, 6, but at least 3 decimal places should be kept. Then 0.756, then it's 0.657, then it's 0.571, then it's 0.497. Sorry, it's 492. It will become 492. See, I have not written 6 decimal places, but I'll pick up the solution which is given in the material only. Okay. Can you also compute the PV factor and let me know if you have faced any challenges in computing the PV factor? All of you. Yes, all of you. Have you computed this? Done? Done? All of you? Yeah? Okay, so then we will now compute the net present value, which is nothing but A into B. A into B. And this is something for which we use market rate at the rate 15%. So in the first year, we get 1,30,434.75. Then we have 113,421. 60. You can all compute this on your own. Then we have 98,627. 0.40. Then we have 85,762.95. Then we have 74,576.55. So the total amount is what? Total amount becomes 5,02,823.25. So this will be the amount of financial liability, or you can say the present value of the financial liability component. And now, how do we get the value of equity? Very simply, 15 lakh, that means the total value of the instrument less the fair value of the financial liability will become the amount of equity. Correct? So equity portion is what? Total proceeds, or we can say total value of instrument less fair value of financial liability. So this is 15 lakh less 5,02,823.25. So what do we get? We get 9,97,176.75. Okay. Yeah. I think Anjali has solved all the numbers, which is good. Ambika is getting 5,02,500. See, your answers may vary. If you are getting 5,02,500, that could be because of the decimal places, which may be different from what is considered in the study material, and which is okay. There is absolutely no problem. And Ambika's response on equity therefore changes. So that means the answer, yeah, which is absolutely fine. There is no problem with this. Okay, yeah. Now what do we have? Now let's again try to understand, because now comes the most important part and the most tricky part of the question. See, these type of questions are easy to solve when you have the conceptual understanding, but still there could be a trick which you may miss, or there could be a point which you may miss, and which is very, very important for you to remember, and that is about transaction cost and its allocation to two components. So our instrument, or you can say the total value of instrument, was 15 lakh. So we have divided this into two parts: financial liability and equity. So we have divided this into two parts: financial liability and equity. So the component of financial liability is 5,02,823, and the component of equity portion is 997,177. So if we remove the decimal places, okay, and the total cost which has been incurred for issuance of this instrument is what? 30,000. So we have incurred 30,000 for issuance of this instrument. So that means for 15 lakh, 30,000 has been incurred. And now what do we need to do? We also need to allocate this 30,000 to both of these portions, because nowhere in the question it's specified that this 30,000 pertains to only financial liability or only equity. So that's why what will be the requirement? The requirement will be to allocate this total cost of 30,000 to two portions. Okay. And how do we do that? On the basis of their fair values, which are these two. So in this proportion, we will allocate 30,000. So what do we get? We allocate 10,056 to financial liability. So this is allocated over here. And 19,944 to equity. So this is the second portion. And you can all compute these numbers. Simply 30,000 in this ratio. Yeah? Clear? All of you? Yeah? Any questions, any doubts? In case you have up to this stage, please let me know. Because after that, it becomes similar to what we have just solved. The last question that we did, now this will become similar to that. Okay? Yeah? Now, as a next step, what do we need to do? We need to do the accounting of equity, including its transaction cost, and accounting of debt, means a financial liability, considering its transaction cost. So now, once again, what will happen? We started with market rate of 15% per annum, on the basis of which this financial liability has been computed. But can we continue with this rate? No. Because now transaction cost is involved. And the moment transaction cost gets involved, what will happen? The moment transaction cost gets involved, what will happen? Yes, tell me, what will happen? We'll have to recompute the interest, because now the interest will not only have the interest portion, this will also have the transaction cost, which will make it effective interest rate. Yeah. So that means for this, we will have to compute the effective interest rate, which is given in the question. It's considered at 15.86. Okay. Yeah. So now let's move on to the next part of the accounting. So now we will move on to the financial liability accounting. So once again, we'll have to just plot these numbers and compute the amortization. Yeah, or compute the amortized costs on the basis of EIR. Okay. So financial liability. So we'll have year 31st March 2000 x2, 31st March 2000 x3, 31st March 2000 x4, 31st March 2000 x5, 31st March 2000 x6. Yeah. And we will begin with the liability amount. So what's the liability amount? Opening balance. Now, if you remember, we computed our amount as 5,02,823. 5,02,823. Now, if you remember that whenever we do the accounting of financial liability under the amortization schedule, so what do? We reduce the transaction cost from that. So what's the transaction cost? 10,056 minus 10,056. So what do we get? We get 4,92,767. All right. Yeah. On this, now what do we need to do? On this, we need to compute the interest at the year end. And we need to compute the interest using which using which my closing liability will become zero. So that means I'll have cash flows. So let me just put the cash flows over here, after which we will get the closing balance. Okay, so every year we understand what's the cash flow, 1,50,000. So this is fixed for us. This is fixed year on year. This is once again fixed. This is once again fixed. This is once again fixed. Now I need such a rate of interest using which my closing balance after 5 years should become zero. Or you can say should become equivalent to the amount which will be repaid. So that means the total value of financial liability without considering the present value. Yeah, clear? Okay, now in the question, interest, that means the effective interest rate is what? 15.86%. So this interest rate is given to us. So we'll begin with this. So we can compute the interest now year on year. 78,153 in the first year. Then we have 66,758. And we can also compute the closing balance in the first year. It becomes 4,20,920. So we will carry it over here, 4,20,920. So the closing balance of last year will become opening balance of current year. And in the second year, what's the closing balance? 3,37,678. 3,37,678. 678, which will then give interest of 53,556. 53,556. And then we get closing balance of 2,41,234. 2,41,234. And then we get interest of 38,260. And then we get 1,29,494. On which we will once again compute the interest, 20,506, and which will make it zero. Yeah, clear? So with this, our computations are all done, but we are left with the accounting entries which are required to be done for all the 5 years. And the other part is about equity, for which we don't prepare any such schedules. Yes or no? We don't prepare any such schedules. Yeah. So let's now move on to the accounting entries year on year. I think Ambika has also computed the numbers over here. Ambika is saying that the interest will be at ICAI. Yeah. So now we will move on to the accounting entries. And please remember, the accounting entries will not start from the year end. Those will also be required to be passed at the time of initial recognition. So the accounting entries will start on 1st of April 2000X1. On this date, what will be required to be recorded? Compound financial instrument. So we are getting a bank balance of 15 lakh. Correct? Bank account debit, we are getting 15 lakh, but we are also incurring a cost of 30,000. So what do we get? Do we really get 15 lakh? No. So either we record 15 and we reduce this 30 later on, which we don't do under India. So what do we record? We will record 15 lakh minus 30,000. So this will be 14 lakh 70,000. The corresponding part will go to equity. And this equity is what? This has already been computed by us. 9,77,233. To financial liability, which is nothing but the preference shares. What's the amount? 4,92,767. So the recording on the opening day, that means on day 0, is done. Correct? Now, as regards this equity, do we need to do anything about it? No. At year end, nothing will happen to the equity because equity will not be remeasured. Equity will continue to be recorded at cost. But this is a financial liability which will be required to be subsequently measured. So every year end, every reporting date, this will have to be remeasured. Yeah. So for this, we will now move on to the end of the year, 31st March 2022. And now what do we do? Yes, tell me. Now what do? We will now accrete interest on this in the first year. Yeah. So we'll say finance cost debit. What was the amount of interest? Go back to the repayment schedule. 78,153. To financial liability. 78,150. So the financial liability has now increased by this amount. And what's the next step? Pay the financial liability. Financial liability debit to bank. What's the payment of this financial liability? 1,50,000. That is in the form of dividend. $1,50,000. And all of you, please remember that for each and every accounting entry, you will have to write narration. If you don't write narration, you lose marks. Okay, so I am not writing it. That doesn't mean that you need not write this. So if you don't write the narration, you lose marks. Please remember this. Narration is very, very important in the exam. Okay, clear? Yeah. Now, what's the next step? Next year, once again, same set of entries will be repeated. Once again, interest will be computed and the repayment will be done. So what's the interest amount on 31st March of X3? 66,750. 66,758. And the repayment amount is fixed. Then next year, 31st March X4, same set of accounting entries will be passed, but the interest amount will change. So now the interest amount is 53,556. 53,556. Then once again, next year, same set of accounting entries will be passed, but the amount once again will be different. So this is 38,260. See, the repayment continues to remain same. This is something you'll have to remember. Repayment continues to remain same. Okay, yeah. Then once again, next year, same set of accounting entries will be passed, but the amount will be different. Now the amount of the interest is 20,506. Okay, yeah. Yeah. Okay, so with this, what we have done is, till this year end 5, we have repaid the dividend, but we are left with a liability which is not yet paid and which is then required to be converted into equity. This liability is required to be converted into equity. Yeah, that's the term. At the end of year 5, what will happen? The liability will get converted into equity. Correct? So let's see, how do we do that? So we have this liability of 4,92,767, which we started with. This is fully paid. So can we convert it into equity? No. But there is an equity portion of 9,77,233. This continues to be there. To now, on 31st March 2006, this will be converted into equity shares. Let me just explain you once again. So we had this instrument broken into two parts, financial liability and equity. Correct. If you look at the end of 5th year, the balance of this financial liability is nil. But the balance of this equity is not nil. This is 9,77,233. And how do we get it? This is the cost. This has not changed. Now the conversion has to happen. Because of conversion, this instrument will convert into equity. And you may have a question now that, sir, if this is already equity, what do you mean by conversion? Do you mean to say that equity will be converted into equity? Yes. See, currently this equity is in the nature of other equity. This equity was not equity shares. This was equivalent to equity shares, but its legal form was not that of equity shares. So now on 31st March X6, what are we doing? We are changing its legal form also into equity shares. Okay, yeah. And how do we do that? How do we do that? So do we know the number of equity shares that will be required to be issued? Yes. We know on this date, equity shares will be issued. So this will become equity share capital. 5,000 equity shares of rupees 10 each. So this will be 50,000. And we will debit this equity instrument. So we'll say equity debited 9,77,233. Okay. Now, against this instrument, these many shares have been issued, or you can say equity shares have been issued equivalent to this fair value, this face value. What is this face value? So what does it indicate? That the equity shares therefore have been issued at premium. So the balance amount will go to securities premium. And what will be the amount? 9,27,230. And with this, conversion is all over, and we are done with the accounting entries of all the 5 years. Okay, clear on this? Yeah. Any questions, any doubts in case you have on this? Ambika is asking, sir, separate entry of transaction cost is not required. We need to pass financial liability. Yes. You don't pass a separate accounting entry. Whenever you will record financial liability at the time of initial recognition, this will always be net of the transaction cost. That is how you present. Okay. Any more questions, any more doubts in case you have on this, please let me know. Any questions, any doubts in case you have? Yes, tell me quickly. No? All right. So what we can do is we can take a break now for 10 minutes. After the break, in case you have any query, we'll have a discussion on that, and we'll also discuss hedge accounting and the EIR computation. And after that, we'll practice more questions as the time permits. All right? Yeah. So I'm just hoping that you are all now getting more grasp on the concept if you have revised this. Because by practicing all of these questions, which involve so many principles that we have already discussed and which will now be required to be reconsidered by you, you will be able to understand the linkage. Correct? Yes or no? Yeah. Okay. So let's take a break and let's meet after the break. Yeah. Hi, welcome back. So we can now continue with our discussion. Yeah. So before we move further now, it will be good to understand your queries. Yes, quickly. Can you please get on to your queries now? Yes, any questions, any doubts in case you have, please let me know. Yes, quickly. Any questions, any doubts in case you have? Okay, Chavi has specified, sir, page 12.89, illustration number 22. Yes, Chavi. So this was about EIR, I remember. Yeah. And that's what we need to definitely get on to. So conceptually, we'll understand how do we compute the IRR. That will nothing be the EIR for you. Okay, so we'll get on to that. Okay, cost of saying we don't have any further doubts. Okay. So what we can now do is we can just quickly discuss hedge accounting. Okay. Once we are done with the hedge accounting, then we'll get on to this EIR computation also. Okay. Yeah. Now, what is this hedge accounting and what's the benefit? So first of all, about this hedge accounting, you need to remember that we don't need to get into too much details around it. This is more of a summary that you need to understand, and in brief, you just need to understand this concept. Okay, so that's why you should not worry if you are not able to appreciate a lot of concepts around hedge accounting, because that is again not the expectation at this level. We only need to just take an overview sort of for hedge accounting. Yeah. So let's first of all understand about this concept of hedge accounting and the relevance of hedge accounting and where can we apply hedge accounting. Hedge accounting requires two things. One is the hedged item and second is the hedging instrument. So these two things are required for hedge accounting. And let's now understand what is hedge. We have discussed about hedge earlier, and I am using the same example for our reference. What will be a hedge? If we are making purchases which are in foreign currency and for which payment is required to be made, say, after 3 months. Now, because the payment will be made after 3 months, the rate at which the payment will be made, we don't know. Why? Because the payment will be made in foreign currency. Because the payment will be made in foreign currency. And today, we don't know what will be the forex rate. We may know the forex rate today. Say if the purchases are in USD, we may know that what is the equivalent amount of USD in terms of INR. But what is the equivalent amount of USD after 3 months is not known to us. Correct? Yeah. So now the purchased amount or the purchases that we have recorded results in what? Creditor. This has resulted in a creditor, and this creditor is denominated in foreign currency. We can also say it's a trade payable which is denominated in foreign currency. What do we mean by denominated? Means its payout has to be in foreign currency. So now, because of this transaction, what has happened? The entity, say it's ABC, which has purchased, is now exposed to risk of foreign currency, is exposed to risk of changes in foreign currency. Why? Because let's suppose today 1 USD is equivalent to 70 INR. Then there is a possibility that 1 USD may become equivalent to 80 INR. Correct? Now today, if the purchases are 1000 USD, then the INR equivalent payout will be 70,000. But after 3 months, its INR equivalent payout could be 80,000. So that means more cash outflow may happen just because of change in foreign currency. And that's why we are saying this has posed a risk, or you can say exposure to foreign currency. Correct? And this risk is due to what? This risk or exposure is due to trade payables balance. The balance of trade payables that we have is exposed to this risk of foreign currency. Okay, so in this case, what do we say? In this case, we will have to consider some mechanism, we will have to consider some way through which we can avoid this risk, or we can cut down this risk, we can manage this risk. And that is possible through hedging. So that means we want to cover our risk. How do we cover our risk? By hedging it. Okay. Now, what is required to be hedged? This is required to be hedged. Why? Because this is exposed to risk of foreign currency. And let's see what could be the way to hedge. ABC may have 1 USD today, or may require 1 USD, ABC may have 1000 USD today, or may require 1000 USD after 3 years. After 3 months. Now, what can ABC do? ABC can enter into a contract with a financial institution or a bank, wherein ABC may say that after 3 months, I will buy 1000 USD. Okay. ABC will buy 1000 USD from the bank at a fixed price. At a fixed price. So 1000 USD at fixed price. Fixed price means ABC today itself will freeze the amount of USD equivalent with the bank and enter into a contract with the bank, and will say that you need to pay me 1000 USD, let's suppose at the rate 75, because of which ABC will be able to ensure that it is not getting exposed to any foreign currency risk. So whatever is the variation that is fixed now itself, today itself. And let's see how is the situation changed. See, earlier ABC was not sure that after 3 months what will be the value of USD. It may become 80, it may become 90, it may become 85, it may become 72. It's not known. So that's why there's an exposure, there's a risk. But now ABC knows that this will be 75 fixed. Why? Because it will be required to pay 1000 USD, which it will take from the bank at the rate 75 and pay to the vendor. And that's how its risk is managed. Its risk is covered. So this coverage of the risk is called as hedging. So this entire thing that we have been discussing is called as hedging. And I'm sure you know this concept. You may be saying, but sir, we know this concept already. Yes, that's true. Idea was to just go through this concept once again. Okay. Yeah. Now in this scenario, let's identify these two items. Because what is the objective? Objective is to get onto these two items for our discussion. The hedged item means the item which is exposed to risks and which we want to cover up. So can you tell me in this example, what will be the hedged item on the basis of our discussion so far? Quickly. I'll wait for a response. In this example, what will be the hedged item? Quickly now, all of you. In this example, what will be the hedged item? I'm waiting for a response. Yes, quickly. What will be the hedged item? Yes, think about it and let me know. What will be the hedged item in this example? All of you. Chavi is saying so the payment in foreign currency to the creditors. Okay. What about others? Any more thoughts? Ambika is saying so the trade receivable balance. There's no trade receivable, Ambika, over here. Pujita is saying so the currency exchange rate. Okay. What about others? Preeti is saying so the trade payable is the hedged item. Very good. So in this case, what's the item? What's the item which is exposed to risks? It's the trade payable. So what is the item which needs to be hedged? Trade payables. Trade payables are required to be hedged in this case. Okay. You may say, but sir, we are not hedging the trade receivable. Sorry, we are not hedging the trade payable. We are actually hedging the risk which is attached to them, which is true. We are definitely hedging the risk. And what is that risk? Foreign exchange, foreign currency exchange risk. Definitely, but that's the risk. That's not the item. What's the item which is exposed to this risk? Trade payable. So trade payable will therefore become the hedged item. Clear? Yeah. Now, next question. Next question to all of you. Kostav has also answered this. Kostav is saying that USD payment will be the hedged item. I think you must have understood. Okay. Now the next question for all of you. What will be the hedging instrument? In this case, what will be the hedging instrument? Tell me. What will be the hedging instrument in this case? Quickly, what will be the hedging instrument? Yes, quickly. What will be the hedging instrument? Yes. See, as I told you, these are some of the basic concepts which are important for you to understand, because we are just looking at an overview of this. And for the purposes of overview, these small concepts is the thing which you are required to understand, and that's it. We don't need to get into too much details around it. So that's why, yeah, if you understand these, you will be able to just complete this part. Cost of saying, so the forward contract is the hedging instrument. Let me just understand from others. What's the hedging instrument? Yes, what's the hedging instrument? Quickly. Pujita is saying, so the rate which is fixed with the bank for the payment. Very good. So now there is a contract with the bank. There's a contract with bank. There's a contract which ABC has entered into with the bank, that ABC will get 1000 USD at fixed price. What is that instrument? That instrument will hedge trade payables. So now trade payables will get hedged. The risk of the exposure, the risk of this currency in relation to trade payables is covered up through what? Through this contract. So this contract therefore becomes instrument of hedging, or you can say hedging instrument. Clear? Preeti is saying that the USD forward rate is the hedging instrument. Yeah, that's correct. So it's the contract with the bank, which is the hedging instrument. Okay, yeah. Now, the next step. If you are able to go back to our discussions in the previous sessions, we have discussed similar type of example. If I am not wrong, similar type of example we have discussed with the same fact pattern. If you go back to the session on derivative, if you go back to the session on embedded derivative, I used the same example. There's no difference. Then what's the purpose of using the same example and establishing these terms? And there could also be a confusion in your mind that, sir, we use the same examples and the same situation was there, for which we did some accounting, we discussed some accounting. So what do you mean when you say that this will become hedged item, this will become hedging instrument? So what is it that we are now trying to understand for this case, which was not covered by us earlier? So is it that we did not cover something earlier and now we are completing it? Yeah. Does this come to your mind or not? I'm waiting for your questions. Now let me just tell you that this type of situation may be dealt in two ways. One way we have already discussed, and that is called as derivative accounting. Now, what is derivative accounting? The accounting of derivatives that we discussed earlier. You remember accounting of derivatives that we discussed earlier? That was derivative accounting. Okay. Other than derivative accounting, there is also an option of doing different type of accounting, and that different type of accounting is called as hedge accounting. This means that for this type of transaction, or you can say for this type of transaction wherein hedging is involved, so we have this transaction wherein hedging is involved, a company will have a choice either to do derivative accounting or to do a different accounting which is called as hedge accounting. Now, it's important for you to remember that it's a policy choice. Policy choice means company will have to have an accounting policy that what is it that they want to follow. Do they want to follow derivative accounting or do they want to follow hedge accounting? If they say that they will follow derivative accounting, they cannot follow hedge accounting. And if they say that they will follow hedge accounting, then they cannot follow derivative accounting. So that means it's mutually exclusive. It's mutually exclusive. Okay? Yeah. But this accounting policy decision will have to be made by the company. It's a choice. And this choice is freely available to the company. Means company is free to choose this. But this choice comes with certain requirements. As I told you, that hedge accounting is actually a choice. As against derivative accounting, if a company wants to chooses to do a hedge accounting, it comes with certain requirements. It comes with certain conditions. We'll now get onto those conditions also. But the first step for us is to check which type of accounting will be followed. Because both the types of accountings will give different impact in the financial statements. In the meantime, I have also received same responses on this from Ambika and Shani. Now, let us try to understand why will a company choose to do hedge accounting. Okay, clear? See, if you go back to derivative accounting, every time the impact of derivative accounting was going to P&L. As per derivative accounting, the instrument used to get measured at fair value, if you remember, and its impact used to go to P&L. Because of which, what will happen? P&L may get some fluctuations, may get some volatility. If we want to avoid that exposure of P&L, now I'm saying exposure of P&L to derivative accounting, what can we do is we can move on to hedge accounting. Because when we will do hedge accounting, then the volatility which arises due to derivative accounting goes off till the time contract is settled. Let's suppose this is the cutoff date. This is 31st March. If we do derivative accounting, then on 31st of March, when we'll close the books, some impact will go to P&L. And let's suppose if in between over here, we have 30th June. You may be thinking, sir, these were 3 months. Let's ignore that. Let's suppose this is 30th June. Then once again, what will happen? There will be impact because every reporting date you'll do this. So let's suppose company has quarterly reporting. So every reporting date, they will have some impact till the time this contract is not settled, which let's suppose is the date over here. Let's suppose this is the settlement date. Okay. But in case we follow hedge accounting, then the volatility which arises during this period will be neutralized, will go off. That is what hedge accounting helps an entity to achieve. So that is why entities plan to move into hedge accounting. So their exposure to P&L reduces till the time contract is settled. Because at the time of settlement, whatever impact will come, that will go to P&L only. Because up to then, things can get neutralized. Okay? Yeah. So that's the reason why an entity may choose to go in for hedge accounting as compared to derivative accounting. Okay? Yeah. Now, let's come back to hedge accounting. So now we have understood that it's a kind of choice. Now let's come back to hedge accounting and let's understand that other than these two, what are the more elements which are required to be considered in case of hedge accounting? Now we need to understand the requirements of hedge accounting. These two are not the requirements. These two will definitely exist in any contract, because of which we will consider hedge accounting. Now we'll get on to the requirements. See, the derivative accounting requires strong documentation to be done. And let's understand what is that documentation. Robust documentation is required. And robust documentation is required in various aspects. About the hedging, about the hedged item, about the hedging instrument. Then it is also required to assess whether the hedge will be effective or not. What do we mean by effective? Again, the standard elaborates on the effectiveness of hedge accounting. Effectiveness of hedging. I'm not getting into too much details. You can just simply say that what is effectiveness? Effectiveness means achieving the purpose. And what's the purpose of this hedging? To cover this risk. So the hedging will be considered to be effective when it is able to cover this risk. If this is not able to cover the risk, that will not be considered to be effective. Let's understand how this may become difficult to be achieved. See, currently we are looking at theory. We are looking at example. But practically, things will not be so simple for us to understand. And practically, you will not be only seeing only one transaction for which entity will enter into hedging. Do you think that only for one transaction any entity will get into this type of contract? No. When the exposure will be huge, only then the entity will think of going in for these type of hedging. Forget the hedge accounting for a time. Which means that entity will have n number of such type of transactions and n number of such type of balances. One. Secondly, it's not necessary that the transactions might have taken place already. There could also be certain transactions. There could also be certain transactions which may take place in future, which the entity knows today. So maybe an entity has entered into a contract with vendor, or say with various vendors. So entity has got various purchase orders to purchase goods in foreign currency, against which entity will get some credit term and make the payments. So the entity will have exposure of forex contractually. Yes or no? So one is the hedged item, and wherein the hedged item is recorded in the books of accounts. In this case, this hedged item is recorded in the books, but it's not necessary that the hedged item may always be recorded in the books. Think of a situation when on 31st March, entity has also got such type of commitments, contracts with vendors to purchase items, goods in foreign currency. Yes or no? It's possible. In this case, can we say that these are hedged items? Yes, because if you look at 31st March, entity has got exposure to foreign currency. And there's a significant exposure because all of these are signed contracts. Entity will have to execute them. Yeah. Other than this, there could be another type of transaction. Let's think about it. In this case, we were saying entity has got purchase orders. Let's suppose entity doesn't have any creditor denominated in foreign currency in the books. Entity doesn't have any signed contracts, doesn't have any purchase orders which are committed as at a particular date, but entity has forecasted purchases to be made in foreign currency. Once again, if the entity has forecasted certain purchases, see, as on 31st March, which will be made in foreign currency. Entity has forecasted purchases, means entity doesn't have any purchase order, but entity is saying, no, these are my purchases which I'll make in foreign currency. Is there any risk of foreign currency involved on these type of transactions? Of course, yes. There's a risk which is involved. Risk is involved or not? Yes, risk is involved. And for these type of risks, entity may have entered into hedging contracts. Yeah, something like this. So first of all, what do we need to check? We need to check whether the hedged item is recorded in the books or off the books like this. Secondly, let's think about an entity which is large, which will actually enter into these hedging contracts. They may have all these three types of transactions. This one, as well as this one. And for which they may have a combined contract. Now, how do we identify that this hedging instrument will take care of this, or maybe all of them? Do we have any one-to-one mapping of the contract or of the purchases of USD which the entity will do from the bank against trade creditors, against contracts, against the POs and against the forecasted purchases? This is something which is required to be analyzed very carefully by the entity. If the entity doesn't analyze this carefully, what may happen? What may happen? If the entity doesn't analyze this carefully, what may happen? The effectiveness of hedge may not be known. And this is what the standard requires, that we need to check whether the hedging will become effective or not. And for doing all of these things, robust documentation is required to be done, wherein the entity needs to identify clearly what is hedged item, what is hedging instrument, what is the hedge effectiveness. And there are a lot of other things which are required to be incorporated in that documentation. Okay, clear on this? Clear on the documentation part? See, in case an entity wants to follow hedge accounting, the biggest roadblock which the entities generally face is about the documentation only. That's the biggest roadblock. Because first of all, it's not really known to an entity how do they do this documentation. And even if they do the documentation, they are not very sure whether that documentation will meet the criteria of hedge accounting or not. And if that is not done properly, entity may not be able to enter into hedge accounting. Yeah, clear? Okay. Now with this, we have understood broadly about various principles which are required in terms of hedge accounting. This principle further says that hedges can be of various types. And what are those various types? Hedge can be a cash flow hedge, a fair value hedge, or a hedging which involves or which is in relation to net investment in a foreign operation. So we'll briefly understand what are these. Depending on the types of hedges that we have means cash flow hedge, fair value hedge, or net investment in foreign operation. Accounting varies. So that means for each type of hedge, accounting will be different. But once again, as I told you, we don't need to get into accounting details of all these types of hedges. We can just understand briefly once again what are these types of hedges. Okay. And we can then understand how will these types of hedges help us to avoid the exposure or that impact or that volatility of the derivatives onto the P&L. Okay, clear on this? Yeah. So now what I'm doing is I'm just taking you to these types of hedges for the purposes of your understanding. What you can do is you can just go to page number 12.162. Quickly, if you can go to this page of the study material, we can just quickly go through the definitions of these three types of hedges. Okay, yeah. In the meantime, if you have any questions around whatever we have discussed, you may let me know. Yes, quickly. Any questions? Yes, any questions? No? Okay. An entity applies hedge accounting to hedging relationships that meet the qualifying criteria. There are three types of hedging relationships, three types of hedges: fair value hedge, cash flow hedge, or hedge of net investment in foreign operation. So let's go on to first, fair value hedge. What is a fair value hedge? It's a hedge of the exposures. So what are we trying to hedge? Exposure in fair value of a recognized asset or liability. What do we mean by recognized asset or liability? This is recognized. This is recognized. So the changes in fair value of this will be hedged. Or an unrecognized firm commitment. What is a firm commitment? This is a firm commitment. Why do we say it's a firm commitment? Because even though it's not recognized, we won't recognize this, but this commitment is firm today because we have a signed contract. So if there are any changes, exposures in this, that is also tried to be hedged. Or a component of any such item that is attributable to particular risk and could affect P&L. Now we have understood as to what will fall under fair value hedge. Then it says where a fair value hedge meets the qualifying criteria. Qualifying criteria means effectiveness, documentation, etc. Fair value hedge shall be accounted for as follows. So you can go to this flow chart now. On the next page, 12.163. Let's look at this flow chart now. And will not be required to pick up examples. So you may be thinking, sir, can we take one example? No, not required. Only this much is more than enough. For fair value hedge, we will check, is the hedged item an equity designated as fair value through OCI? You remember, equity can be designated as fair value through OCI. So first of all, we'll check that. If we say yes, then what do? Gain or loss will be recognized in OCI. Obviously, any gain or loss will be recognized in OCI. If we say no, it's not designated at fair value through OCI, then what do? Its change in fair value will go to P&L. Correct? Then hedging gain or loss on this hedged item. Hedging gain or loss on this hedged item, what do we do with that? that will be adjusted in carrying amount of hedged item. Simply, this is what you do. Correct. Next, gain or loss may comprises both hedging instrument and hedged item. Yeah. If the hedged item is a financial asset that is measured at fair value through OCI, other than equity designated as fair value through OCI, hedging gain or loss on the hedged item shall be recognized in P&L. When a hedged item is unrecognized firm commitment, the cumulative change in fair value of hedged item subsequent to its designation is recognized as an asset or liability with corresponding gain or loss recognized in P&L. Yeah. Moving on to cash flow hedge. What is a cash flow hedge? It's a hedge of exposure to variability in cash flows. Now we are not looking at the variability of fair value. Now we are looking at the variability of cash flows. Yeah, that is attributable to a particular risk associated with all or a component of a recognized asset or liability, such as all or some future interest payments on variable debt or highly probable forecast transaction. So now we are talking about forecasted transactions which are highly probable. Highly probable means which has more than 80% chances of getting executed and could affect the P&L. Now, for this cash flow hedge, we need to check the qualifying criteria once again, and it shall be accounted for as follows. Let's see. The separate component of equity associated with hedged item will be termed as cash flow hedge reserve. This will be adjusted to cumulative gain or loss on the hedging instrument from the inception of the hedge and cumulative change in fair value of the hedged item from inception of the hedge. Portion of gain or loss on hedging instrument that is determined to be an effective hedge shall be recognized in OCI. Any remaining gain or loss on the hedging instrument which is considered to be ineffective will be recognized in P&L. Now in this case, what is it that we are trying to see? We are trying to see how do we hedge it. So basically the impact in this case is taken to OCI instead of P&L. Moving on to third type of hedge. Hedge of net investment in a foreign operation. Hedge of net investment in a foreign operation, including hedge of monetary item that is accounted for as part of net investment, shall be accounted for similar to cash flow hedges. And let's see this flow chart to just to take an overview of this. Ineffective portion on this type of hedge will go to P&L. In fact, wherever there is any ineffective portion, that will always go to P&L. Let's talk about the portion of gain or loss on hedging instrument that is effective. That gain or loss will be recognized in OCI. Now, because of which, what will happen? Impact will not go to P&L. See, in this case, what are we trying to check? That any changes in the fair value, where are they going? So what do we see? The changes in the fair value around the hedging portion, which is considered to be effective, is not going to P&L. It's going to reserve through OCI. That's why the volatility, the impact on the P&L is not there. And all of them will move on to P&L when? At the time of settlement. Till then, they will remain in OCI. So that's why P&L will not be exposed to this. So that's the advantage of doing hedge accounting. Clear? All of you? Yeah. So I would say this was an overview. This was an overview of hedge accounting. And this is something which you can consider as more than enough for the purposes of our discussion and for the purposes of your preparation also. If you want, you can just go through this study material once in terms of various things that we have discussed. Yeah. All right. Clear on this? Any questions, any doubts if you have? As I told you, please ask now, because otherwise, if you get onto this later on, you may feel uncomfortable. Yes, any questions from your side? Any doubts? No? Okay, so then before we move on to any further question, we can just quickly get on to the computation of EIR or in fact of IRR. Yeah. Okay, yeah. Okay, so let's move on to the computation of IRR, please. See, for IRR, what I have tried to do is I have tried to pick up one example only for the purposes of computation of IRR. Because this is a general concept, which if you understand, then you will be able to apply it everywhere. Secondly, you will also be able to understand this concept when you go through the principles of financial management. So in financial management, this will be largely covered. So anyways, you need not worry. In financial management, you will be covering. But we cannot just wait for financial management to be done and then understand this. So that's why we are just trying to understand what do we mean by this or how do we compute this. As I have told you earlier, what is this rate? This rate is something which gives us the present value on today's date. So what's the present value? Let's suppose if I take an example of say 1,50,000. Okay, say there is a total amount of 1,50,000 which has been considered. Yeah, you can say this is the asset value, correct? Yeah, and we can also put down some cash flows. We can also put down some cash flows. So what are the cash flows? Let me just plot down some cash flows for the purposes of our discussion. Yes, so we can put down some cash flows. Let's suppose our cash flow is for 4 years. 0, 1, 2, 3, 4. And the cash flow is say 30,000 on day 0. Means on day 0 we have paid 30,000. At the end of year 1 it's 50,000. Then let's suppose it's 50,000. and then let's suppose it's 30,000, and then let's suppose it's 20,000. So these are the cash flows. Cash flow means these are the payments. Fine. Okay. Now we need to get the EIR, or you can say IRR, on the basis of which I will achieve my present value of 1,50,000. I need to achieve my present value of 1,50,000. But what do I do? Where do I go? Do I know any interest rate through which I can achieve this? No, we don't know. So if you can go to Excel, Microsoft Excel, all of you must be knowing MS Office. So if you go to MS Office, MS Excel, and I'm talking about this aspect practically now, the way companies do this, the way this is practically done, you can just apply trial and error method. Means just keep thinking the interest. Say you can think about 7%, you can think about 7.12%, 7.22%, till the time our objective is changed. What is the objective? To get onto that number. So that means trial and error method. This is one. Another method which you can use on Microsoft Excel is through a formula which is called as goal seek. I'm repeating, goal seek. In which case you will incorporate the inputs. All of these inputs you will incorporate. And you will also incorporate your target. What is your target? To get onto this present value. To get onto this present value. The rate of interest which will help you to achieve your target with the help of these inputs will be your interest rate. So that is how MS Office helps you through two methods. One is more of manual, wherein you are putting the interest rate time and again and getting onto the right answer. Second is by computing the interest rate through the system itself. But unfortunately for us, both these techniques cannot help, because in the exam we will not have this MS Office. So what do we do? In the exam we will have to compute it on our own. So what should we do? We should just think about any interest rate as the IRR. We should just think about any interest rate as the IRR. So let's suppose I think about 6%. So I have taken interest rate as 6%. On this 6%, I will compute the PV factor. Now you may think, sir, how did you get 6%? Any percentages I can pick. So you may take it 7%, you may take it 8%. So I'm just taking it 6%. Any percentage you can take. And I'll compute the PV factor. So PV factor for day 0 will be 1. At end of year 1, it will become 0.94. You can compute the PV factor. I'm using decimal places only for the purposes of reference. Then day 3, year 2, it will become 0.89. Then it will become 0.84. Yeah. Then it will become 0.79. Now what will I do? I will compute the present value. Because my objective was to compute the present value using these cash flows equivalent to 1,50,000. So let's see, is my objective achieved? So this amount becomes 30,000. This is what? A, B. This is A into B. This becomes 47,000. This becomes 47,000. Then this becomes 44,500. Yeah, I'm just not using the same decimal places for this computation. This is only for the purposes of your reference. Then I'm getting 25,200. Then I'm getting 15,800. So all in all, I got 1,62,500. Oh, my objective is not achieved because I had to get onto an interest rate which will give me 1,50,000, but I didn't get it. This is also called as trial and error method. In the Excel, we can just keep doing it. Yeah. But if you have to do this manually using calculator every time, it takes time. In Excel, you can just do this within few seconds. Every time you change the interest rate, your numbers get worked out very easy. Okay. So now, do I have a choice? No. I have to get onto this present value. That's my objective. Now, what is the option left? No option is left because the exam is going on. I don't have much time. I'll have to just rethink the interest rate. Yeah, I'll have to rethink the interest rate. But conceptually, I know a principle on the basis of my understanding of financial management, which says that if we increase the interest rate, then the present value goes down. If we increase the interest rate, present value goes down. What is my objective? 1,50,000. And I know that my present value at 6% is 1,62,500. So this means if I increase my interest rate, I will be able to reach this target. But once again, I will have to take another interest rate. So now what do? I will take PV factor using interest rate of 12%, which I'll say as C. So I can then recompute the PV. Yeah. So PV factor, I'll just plot down. It's 1.89. It's 0.89. Then we have 0.80, 0.71, 0.80, 0.71. So I have sort of computed this on Excel. That's why I'm able to write it quickly. But you will have to compute it on your own. And I'm just hoping that you are doing this simultaneously. Only then you will be able to understand this concept better. Now what can I do is, I can once again compute the present value and pray that I will now get my target number. Let's see whether I achieve that or not. So this is 44,500. This is 30,000. Yeah. This is 40,000. This is 21,800. Sorry, 300. This is 12,800. Okay, and if I take the total, this becomes 1,48,600. Oh, now what is that one? Once again, I have missed. I have missed this very closely. Can you see this? I was about to reach this 1,50,000, but I could not reach this. Once again, I missed this. Now I'm stuck because in the exam, pressure is increasing significantly on me. Why? Because I have tested computing present value using two interest rates, but I could not achieve my target. So what does it mean? That should I keep continuing checking this computation of present value by keep adding this PV factor or keep thinking about the interest rates? No. No. That's not required to be done. That's not required to be done. Now we will have to just apply some different technique over here, which will be based on these principles only. Let's understand. So I'll clear this part, all of you. Okay. So now what do I see? I see that at 6% my PV came out to 1,62,500. At 12% my PV came out to 1,48,600. So if I increase the interest rate, if I take this as the base, let's suppose if I take this as the base, now I'm taking 6% as the base. Now you may have a question, sir, why you are taking this as the base? I'm just taking it for the purposes of my discussion only. And as I told you, you can pick up any rate. You can pick up any two rates. So what did I observe? I observed that if I took 6% as the base and I took 6% extra, means I increased the rate by 6%, then the PV went down by 13,900. Correct? Difference between these two. How did I get 13,900? Difference between these two. Okay. Now, what is the objective? Let's suppose to reduce rupee 1, or let me just put it in a different way. To reduce PV by 13,900, I required extra 6%. To reduce the PV by 13,900, I required 6% extra. Let's suppose if I have to reduce PV by rupee 1, what will I do? I'm just simply applying the unitary method. 6% divided by 13,900 will be my rate of interest. This will become my rate of interest if I have to reduce the PV by rupee 1. Correct? Or you can just simply say this. Yeah, you can just simply say this. Now, once again, what I do? Once again, I'll go to my base. I know that if I keep 6% as the interest rate, I will get 1,62,500. But what do I need? I need to reduce this PV by 12,500. The difference between these two is what? 12,500. So I've kept 6% as the basis, and now I want to reduce PV by 12,600. So what will be the rate? 6 divided by 13,900 into 12,600. So can you compute and let me know what is the number that you are getting? Can you compute and let me know the number that you are getting over here? Yeah, can you compute and let me know the number that you are getting? 5.395%. Which means if I have to reduce my present value from this number to this number, or just simply my value from this number to this number, then over and above 6%, I need to add this much percent, which means what should be my interest rate? Interest rate to get rupees 1,50,000 should be what? 6% plus 5.395%, which becomes 11.395%. And what you can now do is apply this interest of 11.395% on the cash flows that we had. Apply this interest rate on the cash flows that we had. You will reach the present value total of 1,50,000. You can do this now. You can do this now. I'll wait for a couple of minutes. You can do this. If you'll apply this rate now, you will reach the present value of 1,50,000. I'm giving you a couple of minutes. You can just quickly do this, and I'm sure you'll be able to do this. Chavi has also computed this. Chavi is saying, sir, I am getting 5.43. Is it okay? Yes, that is okay. But as I told you, that is all because of the decimal places. It's all a play of decimal places. So that's why more and more decimal places you have, the more and more accurate your answer will become. Okay. So can you now quickly confirm, all of you, whether you are getting this present value on the cash flows that we had, which I plotted using 11.395%. Yes, quickly. I'm waiting for a response. I'm waiting for a response. In the meantime, you can just note down this point. IRR. What is IRR? It's the discount rate that equates. It's the discount rate that equates the present value of the expected cash flows with the total required present value. Yeah. This is only for the purposes of your understanding. Okay, Supriya seems to have joined us now. Yeah, I think she missed this session, Supriya. Yeah, she's saying I'll attend the business combination. Sure. All of you should attend all the sessions. And not only this, there are a lot of other sessions which are planned. You should just remain available in all the sessions. Only then you will be able to understand the linkages. Yes, quickly, can you please confirm whether you have computed this and whether you are getting the required present value or not? Yes, quickly. Quickly tell me whether you are getting the required number or not. Yes, quickly, I'm waiting for a response. Did you compute that? Are you getting the same answer? Okay, Kaustav is saying yes, sir. We got 1,50,000 when we apply this rate of 11.395%, which is nothing but the discount rate. Very good. Now you need to note down the homework. See, your homework should include illustration number 1 and 2 on page number 12.166. Yeah, this is 1. Then you should also cover question number 2. These are pages number 12.181, starting from these pages. Question number 2, 3, 4, 5. This is what homework for you. Okay, this is all about practicing the questions. This is your homework. Pujita has also got the present value equivalent to 1,50,000. Yeah, clear? All of you clear on this? And you have noted down the homework. Let me just explain you once again. One sort of important point related to this standard. I will not take much time because anyways we are just moving towards the closure of this standard. See, today we are done with financial instruments, and you must have understood that so many sessions have been taken for the financial instruments, and still there could be a lot of points which you may think, sir, this is one area on which we still need to work on, which is true. And there are a lot of questions which you may think of practicing on your own. You should make sure that all the questions of the study material you have practiced as a bare minimum requirement for your practice of this concept. Other than that, it will be good if you practice questions of the last year's exams. Okay, means the question papers you should pick up and the questions of financial instrument from them and the RTPs. If you cover these three things, study material, RTP and past question papers, then there is nothing beyond this which you need to do. Okay, yeah. So this is very, very important in case you have anything related to preparation that you want to follow. And this is, I would say, is the tip. If you cover these three, then you can just be assured that you are not left with anything, and that will be more than sufficient. All right, yeah. Kaustav is asking, sir, how can we reach out to you in case there is any doubt subsequently? See, anyways, we are going to have some more sessions. So anyways, we'll meet again after a gap because you are getting some more sessions in between. So that time we can have a discussion on your queries. Otherwise, also, if you have any query, you can just feel free to send your query on the email ID to the relevant team. I'm sure you all will be having the email ID of the Board of Studies team. You can just specify your query and they will get back to you. They will get back to you. If required, you can just also specify my name and they will discuss that query with me, and accordingly that will be responded to. All right, yeah. So with this, we can just conclude our discussion on the financial instruments. I'm just hoping that now with the discussion that we have had for so many sessions on the financial instruments, you would not be feeling uncomfortable, rather you would be feeling comfortable that this is not something which is a complex topic. Because if you remember when we started off, I told you this is considered to be a complex topic, but my objective will be achieved when you will be thinking this not to be a complex topic but a normal topic like any other. Yeah. So with this, let's conclude and let's meet after some time. Thanks to all of you, and please remember to complete the homework. Thanks so much.